We'll say good morning to everybody that's here. It's 10 o'clock, and we are just really delighted to have Jan Hundrieser and Steve Rice with us this morning, and they're going to share their history and insights on the global economic Armageddon. We've all been locked down. We've seen crazy things happening with both the economy and the stock market. And so I think they have tons to share. And we're going to get started right now. And as we always do, we're going to, as Jan always does, goes right through this stuff. Okay. So really quickly, this is our Friday forum, and we've been having these quite consistently since the whole COVID lockdown happened. And although we couldn't meet in person, we've actually have had tons more speakers, tons more content, doing it online. So I think we learned something that moving forward, we want to continue with this as well as physical meetings. We want to thank, if it wasn't for our sponsors and our members, we cannot do this right now. All of our meetings are free, so if you have friends, invite them. Upcoming events, June 24th, you will not want to miss this. This is Josh Phillip. He's an investigative reporter for the Epoch Times. He's going to talk about, does China owe us, or do we own China, or does China owe us or own us? And he's a really young and aggressive reporter. So that'll be a regular SVARW meeting, and it'll be on a Wednesday, so June 24th. And then back by popular demand is Steve Frank. I mean, we've had him twice, and he's been peppered with questions. He has all the insider information on what's going on in California, the legislature, and the California Republican Party. So with that, I will turn this over. I didn't even introduce myself. Okay. It's a crazy day.
We know you, Jan.
So good thing that I don't have to introduce anybody else. They might end up with a different name. So I am going to turn the meeting over to Wendy Brukwinski, our first VP, and she's going to tell you how to ask questions, and then she'll introduce our guests. So thank you so much. Wendy, take it away.
Thank you for being here. And today, as we've done the past several weeks, you can submit questions via the Q&A button or the chat button, either way. And today, it's my pleasure to introduce Jan Hundrieser and Steve Rice, who are with Rice Financial Consulting. Jan's been a financial advisor with Rice since 2007. Prior to that, she spent a couple of decades with bookkeeping, accounting, budgeting, and finance, ultimately running her own firm. She's a master elite advisor with Ed Slott's IRA Advisor Group. And away from the office, she's active in her church on different boards, mission trips, helping with cleanups after natural disasters. She loves spending time with her family, especially her new granddaughter, which would be very fun. I wish my sons would cooperate with that thought. And then Steve Rice, he's been in business for more than 35 years, helping people achieve financial success. He's one of those fantastic guys with all the letters after their name. He's a chartered life underwriter, chartered financial consultant, a chartered advisor in philanthropy, which is really cool. He's a leader in his field. He has served as president. We're trying to get him to serve again as a conservative person on some sort of elected office somewhere. Anyway, he's been president on numerous professional associations, speaking at more than a couple hundred industry meetings and acting as a mentor to young advisors, which is a really cool thing to do. He was on the Los Gatos Planning Commission, Los Gatos Town Council, and ultimately he served as the mayor of Los Gatos. Really nice. He served as president of the Rotary Club in Las Gatos. He's currently the treasurer of the Las Gatos Montessorino Police Foundation, which should be a really interesting thing to hear about now with all this police stuff going on. In his free time, he likes to travel. He loves to golf. You should hear about all the golf courses he's been to around the world. And he likes spending time with his family. So welcome, you two, and take it away. All yours.
Thank you. Now, if I can remember how to share my screen here. Give me a second.
By the way, while he's looking that up, apparently they have this in 4 parts, right, Jan?
Yeah.
And ask you to submit questions after each of those parts. So go ahead and ask away.
There we go. I think I got it. Well, hello, everybody. I'm Steve Rice, and Jan Hundrieser is my business partner, and we are Rice Financial Consulting, along with a couple of staff people. Today, we're going to talk about global economic Armageddon and what's going on today in the economy, and is it the right time to panic? And this was originally written on March 24th. So if the data looks a little different than what you've seen, of course, if you watch the last 2 days, the market's kind of like a yo-yo. So who knows what's going to happen, but we're going to talk about different aspects of it and of the economy and of the markets, and mostly how people are feeling and how they're reacting. So we're going to start with some assertions. One is
Hang on 1 second, Steve.
Sure.
I want to go back to the questions really quickly before we start. At the end of each 4 assertions, like Wendy said, we'll pause for questions because we want to make sure we spend time on what actually interests you guys and not just power through a presentation that we have. So Wendy will let us know what all the questions are at the end of each one, and we'll address them that way. And if we don't stop, Wendy will stop us, right?
Sure.
Sure.
so I don't power through like I just started to do. Thank you, Jan. So the first thing is pretty clear. Many investors are experiencing extreme anxiety and fear. Nobody knows what's going to happen, and the swings are dramatic and large, and the media is just making things even crazier with what they say and what they put up on the way of statistics, and it makes people nervous. And what happens is, unfortunately, some investors panic, and when they panic, they tend to do not the best things for their own long-term interests, and one of those is selling, and we'll talk quite a bit about that. And how we maintain our center, if you will, is to maintain discipline and to understand the context of what's going on. So we're going to talk about the importance of discipline and how it impacts your portfolio. And then finally, to understand that when everything is uncertain, anything's possible. The market could go up, the market could go down, the market could go sideways for 6 months. It doesn't really matter if you're a long-term investor. So we're going to focus on what can happen and what really can't happen in spite of what the media tells you can happen. So first, anxiety and fear. You guys are probably all familiar with this. I actually pulled this off yesterday afternoon. So there's 7.5 million confirmed cases of coronavirus right now, 420,000 deaths. And in the US, we're a little over 8,000 deaths. So if that doesn't give you pause, nothing will. I mean, we are in the middle of a pandemic. When we talk about economic Armageddon, the first thing we have to do is define our terms. First thing is economic. It's related to the economy. And as we're going to talk about today, you have to realize that the economy is not the stock market, and the stock market is not the economy. We all know what Armageddon is. It's a dramatic and catastrophic conflict, like it's going to destroy the world. All right. And if you aren't sure how severe it is, believe me, the media will be happy to tell you. And what has happened, again, this is going through late March, is you can see that the stock market, as represented by the main indices, was down somewhere between 24 and 32%. Now, just to give you a little bit of context, in the Great Recession in 2008, the S&P 500, the top number there, it dropped 50% over the course of 18 months. This dropped half that much in less than 3 months. That's a pretty dramatic decline. And what it leads to is stress. And stress is never a good thing. My oldest son happened to go to the University of Denver. I have no idea who Peter Sokol-Hessner is, but it's a great quote that stress is going to make investors less of who they are, an impoverished version of themselves. And the thing you have to understand is that stress triggers your body. It triggers your nervous system. It triggers your emotions. It's going to change the physiology of your body, and it changes how you react to different stimuli. So as the threat sensitivity rises, you're more likely to bias predictions towards something bad happening. This is psychological, and there's nothing we can do about it. We're all susceptible to it. And any type of stress, even mild stress, impairs your ability to think flexibly, and that's really critical, to draw on the functions of the prefrontal cortex and to exert control. You don't even realize you're losing control of your own emotions, but it's happening. And once we start believing that the apocalypse is coming, a little part of your brain called the amygdala goes on high alert, and it filters out almost anything that says otherwise. You start to minimize the value and the impact of positive news and focus on the negative. And taken in total, the result is an entire population of the country and of the world that's convinced that the end is near. And I think, just editorializing for a half a second, this is what really happened is you got a herd mentality of, we're going to shut everything down because if we don't, everybody's going to die. First time in the history of mankind that we have quarantined healthy people. And why? It's because everybody was freaked out over it. So before we go on to the second section, any questions about that?
I think
Well,
you just.
I'm sorry. I will say, Steve, that when you looked at the chart, the deaths in the U.S. are over 100,000. I think they were 116 or 118. You were looking at deaths in New York. I just want to make sure we get good intel out there.
Yeah, that's right. It is over.
Cause more panic, you know.
Yeah, thank you. All right.
So are we good, Wendy?
Yeah, but that's interesting. So the total deaths are, what'd you say, 115,000?
It was 116 or 118 or something on that chart in the U.S.
68,000 just in New York, was it?
68,000 tested and confirmed cases. I think the deaths in New York were maybe 30,000 or something. Yeah, if you look over, I can't do it with my mouse, Steve, because you're controlling it. But when you look at U.S. deaths to the left, you read the.
I was reading over. Yeah, I was reading.
You read recovered cases.
Yep, that'll teach me to do this without my glasses. Yeah.
At any rate, I just wanted to correct it. That's all.
Bottom line, we got a problem here.
Yep.
But that amyloid, would you call it amyloid?
Amygdala. We'll talk a lot more about that, and we will get to the finances too, but behavior and finances go hand in hand, and people try to intellectualize finances. They try to intellectualize investing, and you really can't, because we're human and we have emotions and all these things. So we're addressing the two things side by side to the best of our ability. We used to have this great picture when we talked about the investor's chief problem and worst enemy is likely to be himself. And it was a revolver with the barrel actually facing the person, so that when you were shooting, you were actually shooting yourself, someone else. But I think compliance maybe didn't like it. And because of this amygdala function and the media competing for our attention, our airwaves are absolutely full of doom and gloom. And there's a lot of external factors that just make it worse. The first of them is social media. This is just an unprecedented crisis in the US, and social media is hyping everything up. And not only is there the fear, but we've been put in a position to judge each other as well. And it's very different from any other crisis we've ever had. Add to that the news and the hype that goes on in the news. Look at the colors that are here. You've got the coronavirus with, it looks like a volcano exploding behind it. In the next one on Fox News, the words kills, the worst is ahead, coronavirus is a war. These are all designed, number one, to grab your attention so they can sell advertising, and number two, to panic you. And when you look at the superlatives in the media, the negative outweighs the positive by 59%. Happy, positive, words like always and best, they don't sell. Basically, if it bleeds, it leads. And you get into the political accusations, and on both sides, the extreme accusations that are going on. So people feel like our nation is dying, not only from a perspective of our economy, but also just and this was written before everything with George Floyd happened as well. And people just really feel like the end is here. So what does all this do? It encourages you to panic and sell. And what that does is that destroys your long-term potential for success. You're making a short-term decision in a panic that affects your long-term financial position. But financial organizations actually profit from it when you do. And Steve, can you go back to that one? Back in 2008, when the stock market dropped 50%, a company that we work with actually went to several different companies and invested $10,000 in each one. And they were trying to do trading online and look at how that was working. And they got to talking to one of the advisors when they were working through some problems. And they asked him how they'd done in 2008. And the response was that we make money whether you're buying or selling. So if people are panicking and selling, they're still making commissions. So you can't look at what they're telling you to do all the time. And those who panic and sell in the long term usually lose. Every now and then someone gets lucky, but that's not the norm. And we all know what panic is. Again, it's uncontrollable fear or anxiety, and it causes erratic or wild behavior. So this is a quick look at what just missing short periods in the stock market can do to you if you happen to miss the best day. And when you take a look at it on the left, from 1990 to 2019, if you had $1,000 in the S&P at the end of that time, you didn't touch it, it grew to 17,000. If you just missed the one best day, it only grew to 15,000. And you can see as you go down the chart that if you missed just 25 days in those 29 years, and they were the 25 best days, you were only at $4,300. And you say, great, I'm only going to miss the worst days, but you don't know what those days are, and you can't get in and out of the best days or the worst days. So again, this was written in March, and these are revisiting the numbers that Steve showed earlier about what, and it actually wasn't 3 months that happened, and most of that drop happened in a week. And we had a client who gave us a call at the end of March, and her portfolio was down 24.45% in a long-term growth portfolio that has 75% in the stock market. So just about what it shows here for the S&P. And she absolutely insisted on selling. And we talked to her, and we actually were pleading with her, don't do it. You're going to lock in your losses. and she couldn't handle the fact that her portfolio was down that much, even though the time horizon on it was correct. And when I ran the numbers on April 1st, what the stock market did from the day after she sold until last Tuesday, there was a 22.2% gain during that time. Now, that doesn't mean the overall portfolio is back where it was in January, but she locked in her loss and took away all opportunity to have that gain. And it was just heartbreaking. So Steve's talked a lot about stress and what it does. In addition to causing you to panic and all that, it impedes your memory. It narrows the variety of choices that you even think you have. It increases the activation of the amygdala. And that's the part of the brain that actually responds to danger, which goes into our instincts. And when you start looking at instincts, you can't rely on those either. You can rely on them to run from a tiger, but they set in on everything. So when you look at October 2007 to February 2009, 1 year T-notes were at 6% and the S&P was down 50%. So what feels good? The T-notes. What feels bad? The S&P. That's painful. We are wired as humans to run away from pain and run towards pleasure. So what your mind is telling you to do is get out of the S&P and buy T-notes. But what happened if you did that? Well, in the next 10 years, 1 year T-notes did 9.7%, but the S&P was up 450%. You have to be disciplined no matter what is going on in the world to ensure your financial safety. Then Steve ran into hurting a little bit. We're wired to want to do what everybody else is doing. This works great for zebras, not so much for humans. Look at what everybody else is doing right now, and usually humans make the wrong decision. There's also something called a recency bias. And what that is you look at what is current and you disregard the past, you disregard the total picture. And there's a little example of it there that's not a great example, but you make decisions based on what's happening right now and forget what the facts are. There's also something called confirmation bias. And what that is that's basically disregarding any facts that don't agree with your beliefs. And facts don't care about your feeling. Facts are facts. But what happens is people watch the news and everything they see is filtered through the way they believe things are happening. And it's skewed. And whatever information your amygdala does not catch, your good Lord, I'm having a hard time. Your confirmation bias does catch it. And that's biased towards confirming right now our imminent destruction. And it just makes everything feel worse. So, Wendy, does anybody have any questions about that section?
I have a question. Like, do you guys follow? Are you going to tell us like the keys that you follow for things like this, or are you just saying stay the course?
We are happy to tell you the keys that we follow.
Yeah,
do you want to wait till see what we cover and don't cover and do it at the end, or do you want us to?
Keep going.
All right. So context, and this is kind of a duh, but it's amazing how much the context of what's going on in our lives and in the world is ignored. Obviously, what context is the interrelated conditions to which something exists or occurs. We talk about deterministic screens. Now, that's a great psychological term. I prefer to look at it more like the optimist sees the glass half full, the pessimist sees the glass as half empty, and the optimist sees the world a certain way and the pessimist sees the world a different way. They're both looking at the same thing, but it's just what their automatic is, and that's what a deterministic screen is. So when we look at the context of crashes, we know that they happen. They happened in 2008, they happened in 2000, and we're going to look at some of these and then what happens as a result of them and after them. The main thing to remember, recoveries are fast and furious. So let's go back to the earliest one of what we call the modern era, because international investing really didn't happen until the 1970s, early 1970s. So after 1973, after the 72 election, there was a downturn in the market. You can see that the market lost about 45% in a little bit under 2 years. And after that, over the next 20 years, the market, it doesn't go up like a rocket ship, and there are dips and ebbs and flows. But if you look at the S&P, I'm just picking that as large cap US, the S&P, $100,000 invested at the end of the drop off, S&P grew to $1.5 million. And we can actually look at it by asset class. And you can see that the average monthly returns were pretty staggering in the stock market if you were willing to be disciplined and not panic and get out of the market. Where Jan referred to what happens if you miss that one best day of the market. Well, take a look at this. This is kind of interesting. The market dropping really dramatically in very short periods of time, 35% in 7 months, 31% in 5 months. And then look what happens. 71% that the US small caps went up. 71% in 5 months. Microcaps, 77% in 5 months. Now, if you said, oh my gosh, this is horrible, I've got to get out of the market, look what you missed while you were paralyzed with fear. And it doesn't end. So when you see the market doing this, it recurs and recurs and recurs. You can tell this wasn't written by somebody here in Silicon Valley. I've always called it the tech wreck, never the tech crash, but same thing, $5 trillion in market value gone. Well, was it really gone, or was it gone if people sold out? If you stayed the course, you did better, and we'll look at that. So the NASDAQ dropped 77%. But then look what happened. Again, NASDAQ.
Steve, let me jump in here just to speak to Wendy's question about what's our personal philosophy on how we do things besides stay the course. We're looking at the S&P because that's the most commonly tracked and known. But part of our philosophy is total diversification, not that just in the US with small in value, but also internationally. So all of these asset classes that we're tracking here, even though we're talking about the S&P, our portfolios own all of them.
And that's a great point. And the other piece of that, which really isn't covered here, is something that we talk about is called rebalancing, which is you buy what's down and sell what's high systematically and automatically. So when when NASDAQ and the tech stocks dropped dramatically, we were actually buying them rather than selling them, because what that does is that gets you in at a lower price. And when it does recover, and it will, and you can see you had to live through 2008, which wasn't fun, right? But from 2002 through 2019, again, 100,000 grew to $500,000. 17 years, 17 years, you got 5 times your money if you just stayed disciplined. And again, here's our chart of the various asset classes and how they did. And again, here we go. We look at micro cap down 25%, small cap down 26%. And look at this over the course of less than a year. These went up 83, 88%, these asset classes. So if you had bought them when they were down because they had dropped, you did even better. And that's something that that's a kind of a core piece of our philosophy, is rebalancing. Of course, the Great Recession, All right, $30 trillion lost. And look what's happened since. I often talk about what happened if you just kind of went to sleep at the beginning of the Great Recession and woke up 3 years later. Well, the fact of the matter is you actually were better off if you had just done absolutely nothing. Because here's kind of the bottom line. Long term, stuff's going to happen, and it's not fun when you're in it. I mean, when we saw what was going on in March, we fielded some phone calls. People were concerned, rightly so. But if you look at the history of the markets, they do well over the long term. If we're talking with somebody about the money they're living on today, they're not invested very much in the stock market. But if you're like me, I'm 60, I've got money that I'm not going to touch for years and years. It's invested for the long term. It's invested primarily in the stock market. I don't plan on ever touching it, or at least not in the near future. So if the market drops a 50% again, I don't like it. It doesn't feel good, but I know it's what happens. So diversification, another part of our kind of core philosophy is we believe in owning a lot of different asset classes. This would be a long-term growth portfolio, 70% in stocks, 30% in fixed income. We will show you in a second what we actually own in our portfolios. And what you can see is that over the long term, this is 20 years from the end of the war through, 1966, $100,000 invested, pardon me, $1,000 invested. No, 100,000, I was right. Grows to $790,000 over 20 years. And that's right after the stock market was beat down and it was going to be horrible for time to come. From 1973 through 1992, that 20-year period, when the economy was just a drag on and everything was, if you remember, this is actually what led to Jimmy Carter getting elected, of all the scary things. And that 100,000 in 20 years grew to $1.3 million, just in a diversified portfolio. From 1980 through 2000, the Reagan years, 70-30 portfolio did, and this is after Business Week declared the death of equities, the death of the stock market. 100,000 grew to 1.4 million. And from 87 through 2007, again, you got to live through some ugliness, but that 100,000 led to, by the way, I was fairly new in the business. I started in 82. 87, I think the market lost 20% in a day, Black Monday. And oh my gosh, that was the end of life as we know it. Well, maybe not so much. 100,000 grew to 700,000 in 20 years.
I started in 2007, so the next year was 50% down in 18 months. We can't bring on any more partners. It's not good for the stock market.
That's right. That's right. Well, long term, it doesn't hurt. And living through the tech wreck, starting it before the tech wreck hit and through the end of last year, again, we're looking at almost $300,000. But the press will not tell you that there are good days to come because they just don't want you to believe it. Because you know what? Nobody buys a magazine that has good news on the cover.
That's an interesting point. Hey, Steve, if I can interject, we have a question from Dave here. He wants to know if you're 1926, if you're working in current dollars in all of these things, or how that.
Great question. Yes, we are. So 2007, right when things went all to hell, in 2009 was the very bottom. So we're starting before the crash happened, the Great Recession, and it's still over the course of 12 years, you're up about 16%. So we help investors develop the perspective that empower them to avoid panic and remain disciplined. That's really what we're all about. And Wendy, you know this, but we're very big on education. We do education sessions every month because we want our clients to understand what's going on. So we really look at it, a bear market is not a bad thing. It's a gift that generally leads to the transfer of wealth from those who panic to those who remain disciplined. And something you just have to remember, this isn't new. The ups and downs of the market, it's just a normal part of market volatility. And, there's things I must endure and things I must experience. And one of the things we do like to point out is that we don't know where the next 20% in the market is going to be. I don't know if it's going to drop 20% from today or go up 20%, but we do know that the next 100% is going to be up because we're diversified into 21,000 companies around the world and in 82 countries. And for you to lose that 100% would take, a global extinction type of event. And if there were one of those, what's going on with your money is probably not high on your priority list. So we believe you can be prepared. We understand that when you're in it, it feels like it's never going to end, but it will. Stocks are long-term investments, and short-term fluctuations, I think it's probably a little absolute to say they're meaningless. They're unimportant in the context of the long term. Because as Jan said, market prices are random and unpredictable. And to draw a little bit of a parallel, if you've lived in this valley for any length of time, I was fortunate enough to grow up here. I remember when housing prices crashed in 2000, but you don't sell your house just because the value's gone down. Why would you sell your portfolio? Because this too shall pass. So before we go on to the next section, Wendy, any questions?
There is an interesting question here from Norma. She wants to know, what about investments in gold and silver? Any precious
Gold
stuff?
and silver are great for jewelry, not so much for your portfolio. If you look at the historic values of gold, I use gold more than silver because I don't follow silver as much. We've got video from 20 years ago when gold was at 1,700 and they were talking about $2,500 gold. Well, where's gold today? 1,700. So historically, it is not a good inflation hedge. Historically, the equity markets beat gold substantially. Doesn't mean it happens every day, every quarter, every year, but long-term, put gold on your wrist or around your neck, but probably not in your portfolio.
It's marketed though. It's definitely marketed as the way to go when things are uncertain. But I have yet to walk into Safeway and have them accept gold for food. It's not a liquid asset, so that can be scary too.
So you steer away from precious metals?
We do. It doesn't mean we don't have clients that want to put some in a safe or something. We just don't. We don't think it's a
Long-term
money making. Yeah, it's not a money making investment.
Okay.
In the long run. Something to point out here too is when we're talking about short-term losses are meaningless, quote unquote meaningless. It sounds flippant, but it's not, because one of the keys to your portfolio is making sure that you are properly invested for the timeline for your money. So if you come in and say, I'm going to buy a house in 2 years and I want to put some money somewhere for 2 years, it's not going to have much in the stock market. Obviously, that's very meaningful if you lose that money, but it should not be invested in the stock market at a very high percentage anyways. So when we're talking about, everything we talk about is within the context of being properly invested for your timelines and your age and all kinds of things. All right, should we move on, or are there more?
Yeah, forward.
Okay. So one of the things we want to understand is no matter how bad uncertainty feels, that's when there's a lot of possibilities that open up for you. And if it's not the coronavirus, it's going to be something else. One of the things that causes a lot of volatility in the markets is election years. So we've got that on top of it. And the markets don't enjoy uncertainty. And until someone's elected, we expect some volatility. And what that means is that things are out of your direct control, and that never feels good. So what if you could control it and you could predict the future? Would that help you? That's the question. So we're going to look at a couple pandemics that have happened in the past, and we're looking at them knowing that this is unprecedented. They've never quarantined healthy people before. If you were quarantined, it was because you were sick, but it's still really all we have to compare it to for the most part. So the first thing we're going to look at is SARS in 2003. And if you take a look at it, the year that SARS was attacking, look at what the stock market was doing. And most especially, look at international. International was up 34% that year. And internationally, the world was affected far more by SARS than we were here in the US. When you go over and look, the returns, the total returns, gross of fees, are not amazing for the next 5 years afterwards, but you have the 50% drop included in that because this is through 2008. But look at international. International, that was the most heavily affected, was up 17%, and that's an important thing to be looking at. The next one we look at was the bird flu in 2009. Take a look at that and look how well the market did in the year of the bird flu. Go 5 years out, and the annualized rate of return is 8.7, 16%, 14%, and so on, right on down the middle column. Those are great rates of return to be averaged over 5 years. The next one's the Ebola, and again, that affected internationally more. You can look in the first column at how the markets did that year, and again, go out 5 years, and you can look at the total gross, and the stock market did just fine, just fine. So forget pandemics, because they're not as common as recessions. What if you could predict the recessions? We're taking a look at them here from 1900 to 2010. Trying to get this, I've got something right in the middle of my screen, making it hard to see. So this is gross domestic on the last chart. Steve, sorry, go back one. Look how much more often it's up or down, but what if you could predict the downs? You'd want to get out of the stock market, right? Well, here's the thing. During recessions, real GDP growth is negative 4.37%. But equities grew 11.27. All years, whether it's a recession or not, GDP is 3.31 and equities are 8%. Equities on average, not every year, not every time, but over 110 years, they do better during recession years than they do during normal years. And that's because...
No, sorry. This is why we make it really clear that the economy is not the stock market and the stock market's not the economy. They do not move in sync.
That's exactly what I was going to say. And one of the ways to really differentiate it for yourself is that the economy is everything. It's all these small businesses that have been so severely hurt by the shutdowns. That's GDP. But the stock market, even when they say, hey, it's a small stock, of a small company, it's still a company that's large enough to have stock that's publicly owned. So they are large companies. They're just the smallest of what's publicly owned. So again, we both just said it, low GDP does not predict low future stock market returns. Something else we can look at that illustrates this is during World War II, 75 million, it's actually 70 to 85 million people died. They don't have everyone counted, but 75 million people died, most of whom were civilians. That was 3% of the world's population at the time. But the stock market annualized made 12.68% per year during World War II. We look at other crises, and each of these, the first column is after 1 year of the crisis, the second column is after 3 years, and the third column is after 5 years. We're looking at the 87 stock market crash, the 89 US savings and loan crisis. In 98, you had your Asian contagion, the Russian crisis, the LTCM collapse. We've got the dot-com crash, the 9/11, bankruptcy of Lehman Brothers, and the US debt downgrade in 2011. And each and every one of those crises, they were doing better or the same at 3 years. They were doing better at 1 year, except for the 9/11. But every single one of them, after 5 years, the stock market was doing better. So if we look at ups and downs, this one illustration here, you can really just glance at it. The big blue things are growth in the stock market, and the little things underneath are bear markets. Look at the time frames in comparison. You've got bear markets of 6 months, 34 months, 19 months. When you look at the growth period, they're usually much longer, 181 months, 155 months. The stock market does better far, far more frequently than it does poorly. And then what we hear a lot is we've got a new market high, so now it's going to crash. It's a new market high. I need to get out because we're at an all-time high, and that means you have to go down. That's actually not true. And this doesn't illustrate it as well as another chart we have that just shows stars all the way up it, showing market highs. But 1 year after market highs, from 1926 until just last December, 1 year later, the market on average is up 13.9%. 3 years later, on average, it's up 10.5% annualized. And 5 years later, it's still up almost 10% every time there's a market high. You just can't predict what it's going to do. So what can you do now? You can work with a financial coach, and Steve and I consider ourselves coaches, not just advisors, because we do really, really try to educate our clients about the history of stock markets, how the markets work, and make sure that they don't panic and damage themselves when the market takes the inevitable downturns. You need to remain calm and rebalance, which, as Steve said, our portfolios do automatically. It takes away the human equation and emotions. You need to maintain a long-term focus. And you need to manage the context of everything you're hearing. Most of all, control your media consumption. This goes for your finances, it goes for investments, it goes for the coronavirus, it goes for everything. You want to be educated, you want to watch the news, but if you've got it on all day long, you are just pouring negativity, and it's designed to be negative to keep you watching, into yourself, and you're not going to manage your emotions well.
My entertainment would be gone, though.
Well, you can yell at it. You can sit and yell at the screen. There is that. So just to summarize what we've talked about, the 4 things we addressed was that many investors and citizens in general are experiencing extreme anxiety. Some investors will panic and sell. Appropriate contract text is critical to maintaining discipline in your portfolio. And just understanding that when everything's uncertain, anything is possible, and that this is actually financially also a time of possibility for you, not just a time when everything is scary and bad.
So bottom line, it feels like Armageddon. We need to put our blinders on and just keep moving.
Keep moving and be disciplined, but be disciplined while being diversified. Being disciplined with one stock or 5 stocks, if those specific companies go down, you're not going to do well. Diversification is the key to discipline. You don't want to be holding a company and just watch it go down.
Mm-hmm. Yeah, that makes sense. We have a couple of interesting questions here from Jane. Actually, the first one's kind of fun. Your advice has been sound during the reign of capitalism, but as socialism is taking hold, I can't get this right.
Amygdala.
That one. This will remain true. Thoughts? What are you thinking as we move towards socialism here?
Yeah, you can make that argument, but I would probably argue that that's as much a function of the press feeding you that as it is reality. We are still fundamentally a capitalistic society. Private property ownership, capitalism is what determines who wins and loses.
Mm-hmm.
If we weren't buying from Amazon wouldn't exist. Anybody can get themselves into a better state in life by serving a customer. And I think if you look at the fundamentals of our economy, forget the politics for a second, we are still fundamentally a capitalist society, and that's not likely to change anytime soon.
Because
And the thing that's really funny is a lot of the people who consider themselves socialists that are, further on the left, a lot further on the left, when we meet with them, it is super interesting that they give us their socialist stance until we discuss their own portfolios. When they discuss their own portfolios, they are all for capitalism. They don't call it capitalism, but everything they tell us about how their portfolio, they want it to work, is very much capitalism. So there's definitely a going on in the brain.
Disconnect. Yeah. And I think a part of that is actually a result of our education system that has minimized the damage that socialism and communism have done throughout history, and focuses on the evils of capitalism. But fundamentally, people in their gut are capitalists. They just don't know that that's what they are.
Right. Okay, another question from Jane here, which I'm really curious about too, because I own some rental real estate. How do you perceive your California real estate holdings in relation to your portfolio?
Well, so real estate can absolutely be a part of your overall portfolio. You just have to be really careful that you don't overextend. I had a couple of friends who got into buying rental properties in resort areas to run on Airbnb, and they did great until coronavirus hit.
Yeah.
And now they've got mortgage payments and the like, and they have no income because nobody's traveling. So, real estate is, you still go back to the 3 most important things about real estate: location, location, location. I wouldn't be buying rental real estate in Lodi. If you look at what happened in the last big real estate pullback, when the valley values went down 50%, so the Central Valley, the West Valley, Almaden, West San Jose, Campbell, Los Gatos, Saratoga, Cupertino, Los Altos, those went down maybe 5 or 10%. So it's still about getting the right piece of property in the right location for the right purpose and in the right proportion to your overall portfolio. You still have to have liquid assets.
So it's all about location.
Yeah, and we talk to clients individually about it because it is a very individual thing. And whether you own property in California where everything's skewed against the owner and for the person renting, whether it's commercial or like apartments or something. All that has to be taken into consideration. There's not, we talk to each client as they're analyzing their real estate purchases, whether or not it's a good one for their situation.
Yeah, that makes sense. One more question for you, actually two. Changing gears a little bit, do you see another stimulus package coming? And what the heck is happening with our national debt here with all of this money we're handing out?
That's a two great questions, actually. The first one's pretty easy because I have no clue, because that's a political question, not an economic question. I did hear Mnuchin come out and say that he's the Treasury Secretary. He thinks that we need one more stimulus package. We'll see. I think there's probably the political will to make that happen. But that ties right into your second question of what about the national debt? And interestingly, the company that we put our investments through has an advisory board, and on the advisory board is Art Laffer. Many of you may remember him as the chairman of Reagan's Council of Economic Advisors. And I was watching an interview he had a couple of weeks ago, and he is, I don't want to say unconcerned, but he's less concerned about the deficit than I would have thought a pretty conservative economist would be, in that he thinks that if we grow the economy, and statistically he's right, he gives the backup for it. If we grow the economy fast enough, and he thinks 4% growth is achievable with the way the Trump tax cuts went through and that kind of thing, that the deficit becomes less important because you can, in his words, you can grow your way out of the deficit.
And hopefully that holds true. Okay, Norma wants to know, what about IPOs really quickly, because our hour's almost over here.
We're not big fans of IPOs because for every one that goes up, there's probably 4 that go down that you never hear about. In our portfolios in general, we don't touch anything that's been on the market less than 2 years.
They analyze it after a year that it's been public, and it has to follow a list of criteria, but they wait it out usually 2 years just to get rid of the whole gambling aspect of it.
Yeah, that makes sense. Yeah. Okay, on to politics. What if Biden wins? What's it going to look like?
In one of our presentations, we actually have data of how the market does under Republican presidents versus Democrat presidents, and Republican Senate, Democrat Senate, Republican House, Democrat controlled House. And contrary to what I would have thought as well, it doesn't do as poorly under a Democrat president as I would have thought. So again, you're investing in companies.
Right.
And as long as companies are able to do business, that's the main criteria.
Mm-hmm.
And that's where that separation between the economy and the market is probably going to be more broad, is that I think that would personally, and as a student of economics, I think that Biden presidency would be bad for the economy, but that doesn't mean it's bad for the stock market.
Okay. Interesting question here from Ken. He wants to know, when you rebalance, do you balance on the basis of dollars or industry sectors?
We have asset classes. They're the size of the companies more than the industry. We own every industry, but they'll look at your small stocks, compare them to your large stocks or your value. They'll compare international to US, they'll compare stocks to bonds, and there's a certain percentage that every portfolio should hold for the optimal portfolio in that risk tolerance. And if you're supposed to be 10% over here and 5% over here, and you're now 12 and 3, they will sell that percentage. And I think I just did really bad math, but pretend it was good. They'll sell it to bring everything back to the proper percentages, and it automatically sells high and buys low every time.
Mm-hmm. Sounds good. Okay. truly the last question. How much into our next speaker is going to be all about China and our relationship with China. How far is our economy into China? Like, how much are we tied up with them? And what do you foresee in the future?
Crystal ball again.
I know, as the relationship sours or gets better or whatever it does.
So we don't own a lot of stocks in China because it's not a free society. We only invest in free economies. We do have some, like in Taiwan, which is
Hong
free.
Kong? I think we have Hong Kong, don't we?
We do. And of course, that's shifting as to how free that is or isn't. But I think the question is more of a political question, like how much there seems to be, again, a will politically to bring more manufacturing back to the US, but it's an economics question. I mean, are you willing to pay 20% more for your iPhone because it's made in the US? And I hate to end on a question that we really don't have an answer to, but I think that really is a political question more than an economic or market question.
That is a huge question too, because it's not just the extra cost, it's the added employment, and there's so much to that. It's an interesting thing.
It's huge.
Yeah. Okay, I want to thank you two very much. This has been very informative. And we've had a couple of questions about how to get in touch with you, and will this be online? Can people watch it again? We will be, Mingy is out there somewhere, and she's going to post-process whatever she does, her magic, and then she's going to put it on our YouTube channel, and we'll send it out to everybody from there. With that, I'd like to thank you very much, and we hope to have you back again someday.
Be great, thanks.
Thank you very much. And we'll say we do monthly education, and we're doing the same thing as you. And if you want to be invited, just email us, and we'll add you to the list.
And they're always fun dinners too. Really appreciate
Free
it.
of charge. It's like what you guys are doing. It's to educate people.
Yeah, it's really fun. Okay, thank you too, and we'll talk to you soon.
Great.
Thanks.
Thank you.
Okay, bye-bye.